All right, good afternoon. Good afternoon, everyone. It's nice to finally be with us, like here. And I want to, like, as I said earlier, I want to like congratulate you on taking this step, on taking this, making yourself available to learn and to, to improve your life for this life-changing opportunity. Congratulations. And as we said earlier, this is a supplementary class, so it means that we are going to be like going over a number of things that we've checked before. We are going to be like running through our syllabus, going through our slides from the very beginning, up to the end. And as I said yesterday, for those of us that have gone through the text and the messages, that in this particular supplementary class, we have three basic goals. We have three things that we are trying to achieve in this class. We have three things that we are trying to achieve in this class, that we seek to achieve rather. And then those three things, first thing is to lay a very strong foundation. All right, is to lay a very strong foundation. And when I mean very strong foundation, it means that a very strong foundation where you can build your trading journey on. A strong foundation where you can, because oftentimes what the foundational learning that somebody has about a thing matters a lot in how the person turns out while learning that thing. All right. So number one goal that we are going to be achieving with this class is that we are going to lay a very strong foundation that you can build on, for years and years and years to come. Now, number two is that we are going to take you to a point where you can accurately interpret and effectively execute trade signals, because it is one thing to receive trade signals. It is another thing entirely, to know how to execute those trades, to know how to like effectively, how to effectively manage those trades. How to, okay, this is the instruction that is given on the signal group. Now, this is how to go about handling that information on your trade. So that is our second thing. That is the second thing that we are going to be seeking to achieve in this supplementary class. We are going to let me go over it again from the beginning. First one, we seek to lay a very strong foundation that you can build your trading journey on. Then number two, we are going to ensure that you can be tailored in that line. Our training is going to be tailored in that line where you can accurately interpret and effectively execute trade signals. Now, number three, the third one is that want to ensure that you will start making money from the get go. We want to ensure that you start, you become profitable. You become profitable in the market. You become trading the financial market from the get go. All right, and I already told you from the messages we sent yesterday and the communication we had yesterday how we are going to be seeking to achieve this. And we're seeking to achieve this, by adding you guys to like a free signal group where we are going to hold you by the hand with signals and ensure that you are making money as long as like you are making money as you are learning, rather you are earning as you learn. So it's nice to be with us here. It's very nice. We hope that our classes are going to be intensive, all right, and such that we can move at a fast pace and achieve a lot in the short time that we have together. So I'm going to like get right into the class now. I'm going to like try to share my screen now so you can all just follow through and all that. I'd like to say one thing, but let me share my screen first and then we'll see how to move from there. Uh, I want to believe we can all see my screen now. you can, if there's a way you can let me know in the like in your comment section if we are like together, if you can see my screen. Mm, all right, I believe that we are together. I'm just like waiting for you guys to be able to like see the screen so that we can. Okay. All right, I believe you can still hear me. I think it's taking time to load. So, but then I will just continue if you can still hear me. All right. So, basically, what one of the very important thing, one of the reasons why it is important, very important to learn, is because just like every other thing that you want to commit yourself to, and many people particularly have noticed that, particularly when it comes to trading the financial market, we underrate the importance of knowledge. Underrate the importance of actually taking your time to learn. And this should not be like that, because just like every other skill in the world, you must treat this as a skill that requires time, that requires, effort to learn. All right, that requires time and effort to learn. So one of the one of the basic things, and something that is of utmost importance. All right, one of the basic things and something that is of utmost importance is that. So one of the basic things and something that is of utmost importance is that we understand the importance of knowledge. I think you can see my screen now. It's just taking time. That you understand the importance of actually learn, because a lot of times you go around, especially if you are on the Twitter space, all right, on X rather, pardon me, formerly Twitter now. All right, if you are on that space, you see a lot of news flying here and there, or on social media generally. Like, forex is scam, forex is scam. Even from a personal experience point of view, my first contact, I also thought like that. All right. So it brings, and I met friends like even in the uni that thought like that too. And that was all they knew about it. Why? Because most times people approach it as if they are gambling. Now, what does that mean? It means that you don't need to make informed decisions. And oftentimes when you hear the terminology that something is risky, or let's say like, yeah, this thing, is a risk, or is not something, is something that is very risky to do. I want you to change the way you think about that now. One thing it means is that it needs information to be done. All right, it needs information to be done. So when you say that the forex market is something that is risky to trade, what it means is that you need to have information to be successful trading the financial market. All right, you need good information. All right, in other words, you need to learn. You need to learn. All right, and that is why I want to congratulate you once again for choosing to do this. All right, for being in this class. It is one of the best decisions that you've made in your life. Trust me. And by the end of the class, you are going to be on the same page with me as far as that is concerned. So let's just go straight into our slides now. Um, so the first question we have here, it says, do you desire to be financially free and make money in dollars regardless of your location in the world? Can we all see the screen? Are we still seeing the screen? Are we still together? It says, do you desire to be financially free and make money in dollars regardless of your location in the world? And this is very important, as we are still going to get to that very soon, as far as that location thing and the influence it has on on trading the financial markets. But let's just move further. I intend for us to to go a little bit deep today. Now it says, do you desire to be able to afford any school of your choice for yourself and your kids and your kids and your kids? Then so that says, do you desire to make enough capital for the business of your choice without having to borrow money from banks or anyone? Do you desire to make enough capital? A lot of people have different things that they want to use their money for. Some of you now probably some of you probably you want to be like the whiskey and the Davidos of this world, all right? And you want to like you need money to record your studio, to book your studio sessions and stuff like that. So it means that forex trading the financial market can be that avenue where you get capital to do what you want to do. All right, let's move on with that. It says, do you desire to help people around you financially without feeling the burden? Do you desire to help people around you financially without feeling the burden? It says, if your response is a yes to all these questions, then you are in the right place. It means you are doing the right thing. You are doing the right thing. And just as I said earlier, that our promise at the end of this particular training, in fact, you are in absolute luck that you are in this supplementary class, because just as I said when we started, that there are three things that we are focusing on, and I'm repeating that so that we can be together on the same page. I'm repeating those three things that we want to achieve, that we seek to achieve with this particular training. Number one, we lay a very good foundation for you that you can build your trading journey on. All right. Number two, we ensure that you can accurately interpret and effectively execute trade signals. All right. We are going to ensure that you can accurately interpret and effectively execute trade signals. We will start making money. By the end of this training, you will start making money. All right, let's move on from that. Now, benefits of trading the financial market. Why trade the financial market? Why trade the financial market? Well, I'm noticing now that my screen is no longer being shared. All right. So I'll do that again now. Okay, just a minute. Okay, I think the screen is being shared already now. All right, so if you can see the screen, benefit of trading the financial market. Why trade the financial market? So the first thing there is flexibility. Is you can trade at home, office, shop, classroom. You can trade from wherever you are. And I think for some reason, this is one of the things that being a forex trader, that I don't know if I should call it a luxury now. All right. But then this is one of the perks that comes with being a forex trader, the flexibility that it gives you. It means that you can trade from anywhere. I made mention of that earlier about the location thing, that it gives you the freedom that you can trade from anywhere, in your toilet, in your dining. You are just coming out from the bathroom, the towel is still wrapped around you. It does not need you dressed in any way. It does not need you to be in a particular place, all right, for you to trade the financial market. It is flexible. It can be done from anywhere in the world. It also means that if you pick a good forex trader that is in Nigeria, if you just pick him up and you drop him somewhere, in some let's say somewhere in Madagascar, as long as there is service and he has his devices there, as long as there is good network there and he has his devices, he can trade from anywhere in the world. Now, liquidity, number two, liquidity. There is always money in the market. I think as at the last study a few years ago still showed that at least the first market has over $7.5 trillion in volume as a daily turnover in the forex market every day. All right, so it means that there is no alpha or market no day to day. It does not apply in the forex market. It does not apply in the financial market. So there is liquidity. There is always money in the market. The third point here says no boss. You don't have a boss. You don't have, for some of you, that's your dream life. That I can't let somebody to be telling me what to do. Well, if you are like that and you are listening to me, you are in the right place. All right. So the forex market ensures that you don't have a boss, you don't have somebody it means you can work at your own time. I think that is how you see that you can work at your own time. All right. You can work at your own time. There's no employee. You don't need to employ somebody to work for you to trade the financial market. You don't need to have an employee. You don't need it. You don't need it at all. You don't need it at all. Then just your no office also. That's the next point there. No office. So just your phone, your PC, your tab, your device is enough. Your device, don't forget what we said earlier at the first point, the fact that it is flexible. You can do it from anywhere. So you don't need to be tied to a physical location to be able to trade the financial market. All right, you don't need that at all, not in the slightest bit. So what you do need is your device, your device. Then the next one now is risk control. So risk control. I made mention of that earlier when I was like trying to encourage you how that when you hear the terminology that something is risky, what it means is that for you to execute that thing, much knowledge is needed. All right. When you hear that something is risky, it means that for you to execute that thing, you need much knowledge. All right. So now, one thing that the financial market gives you is ability to control your risk. Okay. So it gives you that freedom where before each trade you execute, you know that this is the amount that I am risking for this trade. You know that this is the amount that I am risking for this trade. So it gives you the ability, it ensures it gives you the opportunity to be able to control your risk. Now, this way it means that you can determine, you are in control, you can determine that you are not risking above a particular cap. All right, you can do that with the market. Do you know what this means now? On the flip side, is that every single person that you've ever heard that said that I funded my account is getting I sold all my houses, so Forest took everything from me. I know that you are going to find videos like that on the internet. However, what it means is that all those people knew what they were doing. All right, all those people, what just happened was that everything that they funded, they risked it all. Now, so don't forget that the financial market gives you the opportunity to be able to manage your risk, to be able to manage your risk. The next point there is leverage. All right, leverage. And this is further along in the class, we are going to get to a place where we like expand on this. It means that the fact that you can trade, all right, the fact that you can trade, the fact that you can access the market, okay, gives you access to the financial market at large. It is that the reason for that is because it is being leveraged. You are being, just from the way the word, just from the normal meaning of the word, it means you are being helped. All right, and we are going to see that as we move on in the class on how exactly leverage works in the financial market. The minimal investment, it means that you are not necessarily, you don't have to. And then I like the fact that you will notice that they are together, leverage and minimal investments. That you don't necessarily have to be looking to fund your account with $100,000 before you can start making money from the financial market. Not necessarily. So you can. I like those three that are packed together: leverage, minimal investment, and unlimited profits. So because of the leverage, you can invest minimally and still get stupendous profits from it. All right. So it means that because of the leverage, you can invest minimally, you can fund with your $100, with your $200, with your $300, your $500, and still make profits, from the market. Now, income, instant income. Now, this means that it means you can make, and it's beautiful because you can make money from the financial market now, and as you are going to be seeing from the brokers that we've introduced you to already by now, I believe so, that we've introduced you to, you can make, and we are going to make further explanations on that as the days go by, that you can fund your Forex account now, make money now, and withdraw the money now. It can be that instant. All right. It can be that instant. It can be that instant. So the financial market affords you, where opportunity where you can make instant income. Then part-time or full-time trading, it means that there are people that they are full-time traders, all right, but you can also trade as a part-time trader. You get, there are people that are full-time traders, but you can also trade as a part-time trader. It means that you don't, it's not something that, if it's something that you are an engineer, you are a medical doctor, you are nurses, you are a lecturer, across board trading, what will just be important is the way you trade, the kind of trading that you adopt, depending on your schedule or your 9 to 5, or even you are a student, you can trade part-time and you can also trade, be a full-time trader. Then the next one here is that there is no need for educational qualification. All right. As you see now, that as you are learning about trading now, but for those of us that have opened our trading account, there was no place where they were asking you what educational qualification did you have. All right. So it is not a criteria. It is not a criteria that is needed to trade the financial market. There is no need for educational qualification. Then you can trade anytime you want. And I think this goes line in line with flexibility that we talked about earlier, that you can trade anytime you want. It is that flexible. All right. It is that flexible. While there are currency pairs and stuff like that you might not be able to trade on the weekends and all that, but there's some other indices, from those of you that by now I expect that you've opened your derivative account, that you can trade, across all these, that you, as much as you want to. All right. So you can trade anytime you want. When I say you can trade as much as you want to, it means that you don't have time limitations for you to trade the financial market. All right. So and this goes hand in hand with being a part-time or being a full-time trader. If it is that probably you don't have time at this particular time of the day, this is the particular time of the day that you have time, it does not stop you from trading. All right, you can trade anytime you want. All right, so we move on to um our next slides now. Move on to our next slides now. What is forex trading? What is forex trading? Okay, I think the okay. So what is forex trading? Forex trading simply basically means foreign exchange. Foreign exchange. I believe the okay, foreign exchange. I think we are on the same page now. Foreign exchange. Foreign exchange, like the just like is what is like a contraption, like an abbreviation of some sort, where from the from the FOR in foreign and EX in exchange. So that's how you get the word forex. That's how you get the word forex. See, and selling another at the same time in order to make profit from changes in the exchange rate. All right. So basically, in forex trading, what we are playing around is we are, working around the exchange rate of different currencies, and we are going to get to that the importance of that as the class progresses. We are going to get to the nitty-gritty of that definition. All right, so basically, forex trading, I'm going to go over that again. Forex trading, okay, I think your screen is as caught up with me now. So, forex trading is the act of buying one currency. All right, you are buying one currency and selling another at the same time in order to make profit from changes in the exchange rate. All right, like let's look at an example now. So we are speculating on the price movement of currencies in the global market. All right, so we are basically speculating on the price movement of currencies on the global market. So let's take an example of GBP USD, as you can see on your screen. So we take an example of GBP USD. So if you believe, for example, now take for example that if you believe that GBP, that's the Great Britain pound, will rise against the United States dollar, what do? You buy GBP USD. So GBP USD is a currency pair. Now, in case you are looking like, what is this guy saying? What's a currency pair? Just take a chill pill, calm down. We are going to get there. We are going to unpack it little by little. Just like stay with me and follow the context. So if GBP USD is a currency pair, so if you believe that GBP would rise, like the Great British Pound will rise against the United States dollar, you buy GBP USD. Now, if the price rises, now don't forget, you've speculated. Now, don't forget how I started, based on informed decision. So based on informed decision, you've speculated that okay, GBP is going to rise again. You buy GBP USD because that is your speculation. So if the price now rises, you make profit. If it falls, you incur a loss. Now, in the same manner, now let us flip it to the other side. Now, if you believe that GBP will crash against the USD, you will not be buying the GBP USD. What will you do? You will sell GBP USD. I'm going to go over that again. If you believe that GBP, that the Great British Pound, will rise against the US dollar, you buy GBP USD. And if you believe that the GBP USD will crash against the United States dollar, you sell GBP USD. All right. Now, when you are buying GBP USD, you are buying because you believe that GBP will rise against the dollar. Now, if the price indeed rises, you make profit. And if the price refuses to probably now the price rather than rise is now dipping or falls, as you might want to put it, you incur a loss. So basically, forex trading is the skill of you are analyzing global currency, you are analyzing the global currency market and managing your risk to profit from the fluctuations and movement of exchange rates. So you are analyzing global currency markets and at the same time managing your risk, all right, managing your risk to profit from the fluctuation and the movement of exchange rates. Okay. Okay. Moving on. Moving on. Who trades forex and why? So who trades forex and why? Who are the people that trade forex and why? I believe you can see my screen. Who trades forex and why? So as you can see the screen, you see central banks, corporations, retail traders, and I'm going to like you might be looking at the central banks and there's banks again, like a little bit of distinction between those two. Now, central banks is what you know it to be. Central banks, as you know, each country, every country have um, the central bank. That's like the mother banking, the mother banking corporation or organization that is managing the currency, that's managing the currency of that country. All right. So it is the central bank of each country that is in charge, or of largely of managing. So in terms of policies, and systems that are created in place to to manage to manage the currency of that nation. So all the central banks of every country trade forex. They trade the financial markets, and basically when we say they are trading forex, it means that they are taking decisions. Okay, and I need you to pay attention here. They are taking decisions and making decisions that is affecting their currency. Now, obviously, for example, now look at the example we were looking at earlier, GBP USD, the Great Britain pound and the United States dollar. Now, the I am in Nigeria, I'm in Nigeria, you are in Nigeria, I believe so. Now, allegedly, I think that's the word these days, allegedly. So, allegedly, we are in Nigeria now, and we want to trade GBP USD. Now, the central bank of the United States, they are in charge of of managing their currency. What is their currency? The United States dollar. So they are going to be making policies and decisions on their end that affect the price movement of their currency in real time. What do I mean? That it means that on the global market scene, the way their currency behaves in the global market is as a result of what the central bank is doing. So if their currency is, let's say, is bad on the global market, the central bank can feel like, oh, what's happening? Should we add a new policy? Should we do this? Should we do that? And those decisions that they are making affect me as a trader that wants to trade that currency. Do you get? And that is why it is important to know, and that's why this section that we are is very important. Now, the other part is said central banks. Then it now says banks. So there are major banks in the world. Yeah, I think there's a slide that itemizes that, and we'll get there. So there are major banks that, apart from central banks, there are major banks in the world, the JP Morgans of this world. All right. So there are major banks in the world that also trade, you know, forex, that trades one currency against the other, that trades in the financial market. Now you also have corporations. Corporations trade, corporations trade corporations trade the financial market, also they trade the forex market. And big corporations, big financial corporations, all right, I think places like the hedge fund corporations, they fall under these places where they are also trading the financial markets. Then the last part on the thing is, you have your retail traders. That is where you and I come in. All right, retail traders all around the world also trade the financial market. Now, who trade, as you can see this chart, I'm going to give you like just a few minutes, just look through it. You can see the chart, who trades the forex market, and well, you can see the investment funds, you can see the major banks, commercial companies, central banks, the commercial companies, and you have the retail traders, at the far end of the chart. You have retail traders at the far end of the chart. Yeah, so I was mentioning earlier that I made reference to this particular slide that I made earlier, that we have the major banks in the world, that they are not central banks, all right? They are not central banks, but they are very strong banks in the world, all right? They're very strong banks, and you can see them: the JP Morgan, the Bank of America, the Industrial and Commercial Bank of China, the Agricultural Bank of China, the Bank of China Limited, China Construction Bank, Wells Fargo, Royal Bank of Canada, the HSBC, Commonwealth of Australia, Morgan Stanley, and so you have all these banks that that you can see on your screen, and that I read out. They trade the financial market, they trade the forex market also, they trade the forex market also. Moving on. So we'll take a look at currency pairs now, just the currency pairs, and just for you to know how it looks like, and at least get familiar. We saw an example of GBP slash USD, so it's just called the GBP USD. All right. So if you take an example, we saw an example using that earlier. So you have currency pairs. This is Euro USD. This is GBP USD. This is USD JPY, USD NGN, the AUD USD, like Euro USD, that's euros, Europe spend euro. Then you have USD, that's the United States dollar. You have the United States dollar. So the US will stand for we stand for the United States, while the D will stand for the currency. Usually, not all the time, but a good number of times, the first two alphabets will stand for the country, while the last one will stand for the currency of that country. So in Euro USD, so Euro is Euro, all right? That's Euro is Euro. So then you have the USD, you have the United States dollar, GBP, you have that is the Great Britain pound. Then, if you find out that's JPY, that's Japanese yen, so USD JPY. Then you have the USD and NGN, the USD and the Nigerian naira. You have the AUD, that's the Australian dollar, against the United States dollar, the AUD USD. You have the NZD, that's the New Zealand dollar, against Japanese yen. And now this left side of this currency pairs, as is English language, as you can see they are called currency pairs. It means that you are pairing a currency with another. So Euro USD, so they are called currency pairs. So Euro USD, GBP USD, USD JPY, USD NGN, AUD USD, NZD, JPY, and other examples like this. Now, this is your left side of the part. I mean, the part where you have Euro, GBP, USD. You are looking at your screen now. You see that they are called the base currency. It's called the base currency. While the other part where you have your USD, JPY, NGN, that right hand side is called the quote currency. If you later get there, I'll do a little bit of explanation on that. And I'm going to like connect it. I'll be connecting this to an explanation I did earlier. I'm connecting to an explanation I did earlier about the example that we were giving earlier with GBP USD, that if I believe that GBP would rise, rather, if I believe that GBP will rise against the USD, I buy. And if I believe that the GBP will crash against the USD, I sell. So I'm going to like eventually link that up together, and at least it will show whether you are following or not. Now, the next thing we have there is you have your stocks. You have your stocks. You can see the Apple, the Tesla, Amazon, Google, Alibaba. And it's not just you can buy stocks. You can also, is one of the ways you can trade the financial market. All right. So you can buy stocks of these. You notice that these are companies basically. So you buy stocks of companies. All right, you buy stocks of companies, and it's a thing even here in Nigeria too, where people can buy stocks of banks here in Nigeria, of not just banks but companies. Of You can buy stocks of banks like all these GT banks, Zenith Bank, and even like um companies here in Nigeria that sell their stocks, so you can buy and all that. It's one way to treat another way to treat the financial market. Then you have indices, or should I say another way, or rather, better put is other things that you can trade in the financial market. You can trade your currency pairs, you can trade your stocks, then you can trade indices as well. As you can see, that's Nasdaq. That's Nasdaq. You have your S&P 500. You have Dow Jones. That's the USA 30, USA 500, USA 100, and all that. They are called indices basically. They are called indices. Then you have your commodities. You have gold. It is expressed as XAU. So gold, even though it is expressed as XAU USD, and all that is expressed as XAU USD. Then silver is expressed as XAG USD. All right, and you basically see, I think that is from probably from their chemical symbols of gold and silver. So even though it is expressed like this, it is a commodity. It is not, it is not a currency pair. All right, it is not a currency pair. It is a commodity. All right, so and by commodity, I think even by calling it commodity is more for gold and silver, particularly now. They are metals actually, all right. So they are metals for gold and silver. Um, some broker you find them under metals, gold, silver. I think there are some that there's even platinum too, and it can be traded. So, and then you have your crude oil, your natural gas, cocoa, sugar. Now those are actual commodities. Those are actual commodity. So you can trade these ones. So you can trade your metals, gold, silver, platinum. Then you can also trade your commodities, crude oil, natural gas, cocoa, sugar, and whatnot. Then the fifth one is cryptocurrencies. You can trade cryptocurrencies too, and you can trade your Bitcoin, your Ethereum, Solana, and you find these things usually in the forex chart. You find them you can find them crossed against the US dollar. So you can find that means you find just like you see XAU USD earlier, you would see ETH USD also, you will see SOL USD also for your Solana. Now, you can trade bonds and interest rates, so like treasury bills, treasury yields rather. You can find your government bonds too. I know that there are another ways to another option in trading the financial market. Then the synthetic indices, you have your volatility indices, your step indices, and crash and boom. Now, one thing you should take from this thing that we just went through now is that there are so many options. All right, there are so many things that you can trade, that as a trader you just need to find your edge, that this is what I like. I think I like this one. I think I know how to do this one, and you are good to go. So next we are going to be moving to forex terms, for terminologies in forex, terminologies in forex. So I believe your screen is up. So I believe your screen is up and we can all see the screen. So the first thing here is the trading platform. The trading platform. The trading platforms rather. So you have platforms where you come and trade. So let's see that. So a trading platform is basically like a software or an application. So it can be web-based, it can be a software, or can be an application, it can be a website too. Is it that allows you to access the financial market, to analyze your price chart, and to place, trading orders. So I go again with that. It's on your screen. I'm just like reading it out so you can just read alongside myself. So it is a software or an application that allows you to access the financial market, analyze price charts, and basically place trading orders. So a trading platform, what it does is that it connects you to the market and it allows you to execute your trades. All right. It allows you to see the market live, to see the movement of price live. All right. So a trading platform also enables you to be able to buy and sell instruments. Or what I explained earlier as placing trading orders, it allows you to be able to buy and sell all those things that we were talking about, all your currency pairs, your indices, your metals, your commodities, all right, your stocks, your synthetic indices. A trading platform, is where you get to, to do all these things. So a platform also gives you the avenue to analyze the market. It means that you are able to use indicators and drawing tools. All right, you're able to use indicators and drawing tools here and there to help your analysis of the market. Now it helps you to also to be able to manage your trade, to manage your trade, to manage your trade, to manage your risk, to manage your trade largely for your stop loss and your take profits. A trading platform gives you the avenue to do that, to monitor your profit and your losses, to analyze the market history. So basically, that's what a trading platform is. It connects you to the live market. It ensures that it gives you the avenue rather. It is through a trading platform that you analyze the market. It is through a trading platform that you place trading orders. It is through a trading platform that you monitor your trades as well. All right. And so for this class, basically, the trading platforms is MetaTrader 4, MetaTrader 5, and then which I believe that a number of you, are familiar with. I've instructed some of you towards the download and the installation of this, of these applications now. Then there's Trading View too, and there's C Trader. All right. So all these are like trading platforms. All right. They are trading platforms that gives you, the opportunity, that gives you the avenue to be able to do the things that we listed earlier. To be able to do the things that we listed earlier. Okay. So this is what your screen is looking like now is what, for those of you that are not familiar with chart, with what a chart looks like inside the trading platform now. All right. So what you're seeing right now is what it looks like basically. So that is what your chart looks like. You can see, we are going to get to what these things are called and how to understand this thing that is looking like, for the Yoruba people among you, that is looking like Odufa. But yeah, we'll get there. We'll get there basically. So, but then this is what your chart looks like. This is what your chart looks like. This is what it looks like largely. As we go further into the teaching, you are going to understand, better and better and better. So I'm going to keep coming back to, we are on, don't forget, we are on Forex terminologies. We are on Forex terminologies. And basically, um, so we've seen trading platforms now. Now for candlesticks. Let's see what that is. Now, so this is what your typical candlestick looks like. This is what your typical candlestick looks like. And this that you can see on your screen, this is what your typical candlestick looks like. And this that you can see on your screen is, I believe we can all see that on our screens. All right, so you can see the body of the candlestick of that color blue thing that you're looking at. So that is the body of the candlestick. Now that's the body of the candlestick. And you can see that line on top of the candle. All right, that line on top of the candle, that is called, that is called the wick. That is called the wick, or you can also call it the tail. All right, so that line on top of the candle is called the wick or the tail of the candle. All right, it's called the wick or the tail of the candle. You can see those lines up, just like that like extension above, just that extension above that closing price and the extension below the opening price. Now that is the upper wick and the lower wick, the upper wick and the lower wick. Now, we are going to do something that, like, what you see on your screen basically now, if you bring it to now, this candlestick particularly now, it is a bullish candlestick. All right, this candlestick is a bullish candlestick. So what it means is that you will notice that for a bullish candlestick, the opening price is below the closing price. So for a bullish candlestick, the opening price is below the closing price. The opening price is below. No, just chill. Very soon, yeah, just follow me in context. All right. Very soon, you are going to understand the terminology, what I mean by bullish and bearish, like in few minutes time. All right. But then just know that this particular candlestick that you are looking at, all right, is a bullish candlestick, and you will see clearly that the opening price is below the closing price. Now, look at the small red candle beside it. Okay, you will notice that this small red candle, you can see the upper wick, you can also see the lower wick with the small red candle. Now, however, the small red candle is a bearish candlestick. Now, for bearish candlestick, the opening price is higher, all right, than the closing price. The price closes lower than the opening price. The price closes lower than the opening price. I believe you kind of understand that perfectly. I believe so. All right, so let's move on from there. So next time we're going to be moving to I think peep and lot. We'll see how that works. So peep and lot. Now, as you can see this on your screen, this is called price. You would find this at the right hand side of your, of your chart, at the right hand side of your chart. And if you looked at the slide that I was using to teach you, to talk about the candlestick just now, I'm just going to go back to that slide, and you just pay good attention. So now notice, like, can you see that 1.3979, 1.3993, 1.4007, 1.4021, 1.4035, 1.4049, all those listings by the right hand side of your screen right now? That is what we call price. That is the price. That is the price. That is the price. So I'm going to go back to, like, where we were. So when you have this now, so you understand what I meant earlier when I said this 1.400110 is called price. You understand this labeling. Now, usually, now we have 1.40010. This particular price is in 5 decimals. All right, this particular price is in 5 decimals. Now, what that means is that you notice that the labeling calls the last decimal a pipette. All right, is a fractional pip. Okay, it is a pipette. So it means that when we are trying to, probably do our calculations of pip and lot, we don't, we don't factor in, as it were, the pipette. All right, so it means that we stop at the fourth decimal place backwards. Do you get that? So it means that what we are bothered about in this particular price now is 1.4001. So, and why is understanding of pips important? And it is something that I'm going to take my time to explain well to you. Now, why is understanding of pips important? It is important because price moves in pips. Now, it is important for you to have price moves in pips. What does that mean? It means that if the market is at this particular price that is on your screen, 1.40010, so it means that it is going to move like this: 1.4002, 1.4003, 1.4004, 1.4005, or 1.4000, 1. Now 1.3999, 1.3998. So price moves in pips. Price moves in pips. So and hence you to understand the movement of price, you have to understand how pips work. Do we get that? So I believe that is like self-explanatory. I believe that is self-explanatory. We'll see how we move from there. Okay, I think we already explained this earlier. We already made a reference of this earlier that you have your United States, the country, and then the currency, and how this currency pairs their symbols, how their symbols were arrived at. Be arrived at. And I want you to pay attention to what is on your screen. It's a, what do we call this thing in back in, it's a pie chart, as you can see it. It's a pie chart, and you can see how much volume, you can see how much volume the United States dollar is taking in the chart. So you can see how much volume the United States dollar is taking in the chart. Then you can see your euros too. All right, you can see the volume that euros is taking to. Then you see Japanese yen, you see your pound, you see your Swiss franc, you can see Australian dollar, Canadian dollar, New Zealand dollar. I'm sure that you are not seeing Nigerian naira anywhere. But you see that place that there's order, that place that the root order, it's just one tiny place like that. You can put the naira there. That order means every other currency in the world is scrambled up all right in that, small space. But then this tells you something. And as we are later going to get there, when we start looking at your major currency pairs, okay, this tells you something that US dollar is major in the forex market. Is major. As you can see the heading of this particular pie chart, it says currency distribution of reported FX turnover. So US dollar, United States dollar is important in the forex market. Now, don't forget, we spoke about the central banks of these countries managing the currency of these countries. Why? Whatever happens to that currency is what the live market shows us. And that is how a retail trader makes his decision about those currencies. So it means that as a trader now, you have to be bothered about the economy of these places. Why? Because the economy of these places are directly affect the currency of those places. Now, for example, now look at what has been, look at what has been happening largely now with the war between between your United States, Donald Trump basically, and and that almost pathway that the oil has been blocked like for some time now and all that. I hear that they said that they should come and pass. But then look at the time, look at the hike that it has caused in the price of 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 oil in the world. Now that is happening. When you now check, we mentioned earlier that you can trade commodities too. Okay, now crude oil is a commodity. We saw that example earlier. Now, if you check the chart, what is happening in the news is happening on the chart too. You can see it there. So you are making, and that's why I said earlier that basically you are making informed decisions. Okay, you are making informed decisions. So what this pie chart looks to tell you is that what happens in the US, what happens to the US dollar, what happens to the European euro, what happens to the Japanese yen, what happens to the pound sterling, those major economies in the world, as it were, now directly affect what happens in the financial market. It directly affects what happens in the financial market. directly affects what happens in the financial market. All right, moving on. So major currency pairs, and then we'll see how we'll see how we can move. All right, we'll see how we can move. We'll see how we can move based on that. So major currency pairs. I want you to hold the thoughts. Hold if you can hold the pie chart that we saw earlier. If you can hold it in your mind, and um we'll just see to that. Waiting for our screens to like catch up. So major currency pairs. You are going to see. You see euro. About seven of them. You see euro USD. Alright, you see Euro USD, USD JPY, GBP USD, AUD USD, NZD USD, USD CHF. That's the CHF is the Swiss franc. Then you have the USD CAD, the USD Canadian dollar. Now, one thing you will notice is that in the all the currency pairs, you find the United States dollar in everything. Just like what I was saying earlier, shows how important that particular currency is to the life of a trader. All right. So you have your just go over that again. Your major currency pairs. You have your Euro USD. Now, don't make the mistake. Oh, it's not everything that have USD inside that is a major currency pair. USD is a major currency pair. USD is a major currency. However, what we are considering is major currency pairs. Okay, so you have the Euro USD. That's a pair. Is a major pair. USD JPY. That's a pair. The United States dollar and the Japanese yen. That's a major pair. The GBP USD is a major pair. The AUD USD, that's the Australian dollar, and the United States dollar, major pair. So the New Zealand dollar too, and the United States dollar, major pair. You have the US dollar and the Swiss francs, that's USD CHF, that's also a major pair. Then you have the USD CAD. So together, and this is why they are, I made mention earlier rather that according to the last research, it is recorded or reported that there's over $7.5 trillion, liquidity or in turnovers in the market every day. All right. So it means that when it says that together, these major currency pairs now account for 70% of that turnover of the forex market. So it means that these are currency pairs to pay attention to. Okay. So these are currency pairs that every trader should pay good attention to. Okay. Now, okay, this I made an addendum to this earlier. I made an addendum to this earlier. The base and the quote currency. I think I said that earlier when we were looking at. I said that earlier when we were looking at. I said that earlier when we were looking at the when we were looking at when we're looking at the example and then we're looking at the listing of those currency pairs. So this is the Euro USD as you can see on your screen. So the euro is the base currency, as I said earlier, that is on, that's the one that you write that you see first. All right, on the left side of the pair. Then on the right side of the pair, you have the USD. That is the quote currency. So you get that is the quote currency. So the value of the base currency is one. Do you get it? Usually one. And the quote currency means that the quote currency is in a way what determines what you see on the price. Don't forget we saw that earlier, that the price is on the right hand side. Okay, the price is on the right hand side of the chart. So the quote currency is what determines what you see on the price. So for in this particular in this particular example now, it's saying that you need 1.4140 United States dollar to make for 1 euro. So it means that 1 euro is equivalent, do you get, is equivalent to 1.4140 US dollar. I'm just going to go over that again in case, just so it becomes clearer, that what you have on your left side is the base currency where you have your euro, and what you have on the right side is the quote currency where you have your USD. So the value of the base currency is always one. That is the base currency. So the quote currency, the other currency is quoted against it. You get is quoted against it. So the base currency is one, while the quote currency now in this instance now the price of USD. The we mentioned earlier too that basically in the forex market you are making money off the changes of the exchange rate. That is how you are making money off the changes of the exchange rate. So here now you have 1.4140. You have 1.4140, and 1.4140 now it means that for every €1, it is equivalent to 1.4140 US dollars. I think I believe that should be clear. I believe that should be clear enough. I believe that should be clear enough. So now we're going to look at risk to reward ratio. Okay, we're going to look at risk to reward ratio, and hopefully we are still going to find this is something that we are still going to like expand on in classes to come. But then I'm going to like set like a rough background, like a framework of what you need to know about risk to reward ratio, and later in the through the training we're going to come back to like expand a little bit more on risk to reward. So basically risk to reward is what it is, what it sounds, what you are risking and you are being rewarded. In other words, another way I can put it is loss to profit ratio, that margin, that ratio. So it means that what are you risking with respect to to what you are getting. For example, take this picture now. I am buying, let's say I go to buy a clothes. I go to buy a clothes and I spend 50,000 naira to buy the clothes. I'm spending 50,000 naira to buy the clothes. Now, if I'm using 50,000 naira to buy the clothes, so if I'm using 15,000 naira to buy the clothes, and that is the cost price. So it means that maybe my transport, everything that was the whole cost price involved in buying that clothes is 50,000 naira. Now, I now sell it, or I want to sell it, I intend to sell it at 100,000. All right. If I intend to sell it at 100,000, all right, that is what I am risking. I am risking 50,000 to get 100,000. I'm risking 15,000 to get 100,000. So that is like a 1 to 2 risk to reward ratio. Do you get? So that's like a 1 to 2 risk to reward ratio and all that. So it means, so what you are risking, basically the amount of pips or the amount of dollars you are risking to the amount of pips or the amount of dollars that you are hoping to get. And then it is a general counsel that a good trader must have a good risk to reward ratio. You cannot be risking $50 on a trade and then the potential reward for that trade is $10. That does not make any sense. Do you understand what I'm trying to say? You cannot be risking $1,000 on a trade and then your potential reward, all right, for that trade is $50. So, and you are risking $1,000. That doesn't make any sense. So it means that part of the things that a good trader has, as I said, we are going to get to this, much later in the. We're going to get to this much later in the training. But then basically, that is what your risk to reward ratio is here. What you are risking, what you are risking as opposed to what you have to get to your potential reward. To your potential reward. All right. So I told you we would get here earlier. And then we might just try to um wrap up the class from here. All right. So we'll get here So we are bulls and the bears. So we just see the bulls and the bears. So it says in the forex market, you are either buying or selling. Those are the two things that you can be doing. All right. You are either buying, selling, or you are not in the market at all. Okay. So you are either buying or selling. You are either buying or selling. So it means that when we say that you are learning and you are wanting to learning how to make informed decisions in the market, it means that you are learning, how to you are learning how to know when to buy and how to know when to sell. So you are learning to know, how to know when to buy and how to know when to sell. When am I meant to buy? When am I meant to sell? Basically, that is what you are learning in the training. Now, the buyers in the market are called the bulls, and that was where what I used earlier, the terminology I used earlier when I called a particular candle a bullish candle. That's where that terminology comes from. It means that it is a buying candle. All right. It means that so it says the buyers are called the bulls, while the sellers are called the bears. The buyers are called the bulls, while the sellers are called the bears. Now, so it means that if I say a candle is bearish, what I mean is that the price is selling. You get, if I say something like or USD JPY is bullish, what I mean is that that market is presently like it is going, in a buy direction. Okay, it is bullish. You get, it is bullish. It is going in the buy direction. Now, if I say it is bearish, it means that the bias of the market, all right, is selling. You get, so it means that the market is presently selling. So basically, that is what bulls and bullish. I think by extension, I have explained bullish and bearish too in the way you can use them in your terminologies, okay, or in your diction. If you are, let's say, selling, let's say you are trading, let's look at an example. Let's say you are trading AUD USD, or let's say Euro USD. You are trading Euro USD. Now, if you are trading Euro USD and you are buying that trade, somebody can ask you and you say, "Oh, Euro USD, I am bullish on Euro USD." What it means basically is that you are buying the market. The trade that you executed, all right, is buying the market. You are buying the market. Okay, you are buying the market. Another similar diction or similar like a synonym of buying or going bullish is going long. Do you get? So that's another synonym. I say I went long on Euro USD. It means I bought it. Do you get? I bought. I am buying the market. Do you get? And for bearish now, that's like you are selling. That is going short. You are going short on on a particular currency pair. It means you are selling that currency pair. So once again, the buyers are called the bulls, while the sellers are called the bears. All right, I think this other slide properly elucidates that point. Okay, you can see the way the bull is and why that terminology. Do you get it? It's because from if you, for those of us that know what bull looks like, the strong arms, the bull lifts someone up, just like that illustration that you see. So the market is bullish when it is buying, and the market is said to be bearish when it is selling. The market is said to be bullish when it is buying, and the market is said to be bearish when it is selling. So we're going to be picking it up from here. We're going to be picking it up from here in the next class. We'll see how far we can go. Picking up from here in the next class, and we'll see how far we can go. Let's ensure that our minds and our hearts, are in what we are learning. Just as I said earlier, that you are in for the best time of your life. All right, congratulations on choosing to like learn and choosing to like to commit your time and your resources to actually learning a skill. All right, so We are going to be meeting again in the next class, and we're going to be picking it up from here. I'm going to be re-emphasizing some things and taking the training a little bit further and a little bit deeper than where we've gotten to. So thank you very much, guys. I'm preparing for an assignment in your next class, but then this is just like a welcome class for you all. So have a great day.